Hello, welcome back. So, after yesterday's earnings report, Alibaba at some point lost like 5% of its stock price, but then kinda reversed course and followed the overall market that started going up again. And Nasdaq, I think, was like 3% up when the market closed yesterday. And actually, Baba closed at 0.72% down, which is much better than 5%, right? So in this video, I'm going to be taking a look at some metrics of Alibaba and actually compare them to very big companies like Tesla, Apple, and Amazon. And I understand that Tesla, for instance, is a completely different industry, but still there are some metrics that we can kind of compare with Alibaba and all these companies and just understand some of the core things and core financials behind Alibaba and core metrics really, and what's happening behind the company's operations. So let's start off with the price to earnings ratio. And you will notice that back when Alibaba was overpriced, the price to earnings ratio was sitting at 64, and you can see the value over here as I'm hovering, 64.2 over here. And it started dropping and dropping and dropping, and at some point reached 42 over here, but it was also 19 at some point. So this can actually give you a potential, what's potentially going to be happening in the future, I suppose. But right now, it actually fell again over here and reached 15.5, which is absolutely insane for a company like Alibaba to go that low on a PE scale. Now, what I want to do is actually compare this chart to other big companies, like for instance Tesla. And you will see here that as I'm labeling the chart, Tesla is way higher. It's sitting at what is it, like 146, 163.4. And this is like what, like 20 times, almost 20 times more. It's like 10 times more, actually 11 times more than Alibaba. And obviously you want, the lower PE that you get, the more undervalued the company is, because PE as well is like price to earnings. So it's the price of the stock when you compare it to the earnings of the company. So Tesla is actually being very overvalued right now in terms of its PE, and Baba is massively undervalued in terms of its PE, which is less than 20 even. Now, if I add Apple here, you will see that Apple is also kind of a similar story, but on the on the opposite side. Like Apple used to be low over here, used to be like 17, 19. That's pretty fair, and they actually reached 12 at some point, which is absolutely insane. And of course, this wouldn't keep up with being that low, and so it went higher and higher at some point, then dropped down to 20, which is about fair, and then right now is a little bit overvalued, sitting at 27.1. So even a company like Apple, making tons of cash flow, is still on almost twice as much, also has twice as much PE as Alibaba has. It's almost twicely overvalued based on its PE of the last 12 months. And now I'm going to add Amazon again. And so Amazon, you will notice it's more overvalued than both of those companies, both Apple and Alibaba. And this is why in my channel, I do not really recommend people to buy Amazon right now. And Apple, I'm kind of in the middle. I mean, it's a potential buy, but I think I would want to get a better price. But Amazon, I think it's a fantastic company, but it's expensive. And so the next thing that we're going to examine is the price to free cash flow, which is more indicative because it mentions free cash flow instead of earnings, because earnings can kind of be a little bit manipulated. There is like depreciation, amortization, there's a lot of things that can skew this value. But free cash flow is basically money from operating income minus capital expenditure, so it's much more pure, I'd say. And so over here you can see that Alibaba's price to free cash flow ratio was high at some point, was sitting at like 43, and again here like 37, but now it's at 12.3. A 12.3 free cash flow ratio is amazing, especially for a company like Alibaba. Let's compare it to some other big companies again, like Tesla here. Price to free cash flow of Tesla, look at that. At some point over here it used to be much more fair back in 2019, but now it's sitting at 237. That's basically telling you that for $1 that a company makes for Tesla, you are paying $237 to purchase the stock. This is what it means. So this is extremely expensive, and for Alibaba is like $12.3. So if we add, actually let me actually disable Tesla here and enable Apple. Or actually, let me leave it on so that you can actually see Tesla as well. So Apple here is sitting at a price to free cash flow ratio of 26.1, which is more fair and it's manageable. I'd like to get it a little bit lower if possible, but Apple, somebody can actually make a case for buying it even right now, to tell you the truth, because it's, the price to free cash flow ratio is bearable for sure. It's not terrible. And the next one is Amazon. Amazon again, it's kind of looking similar to Tesla here. Look at that. It has always been overpriced, and I understand that Amazon is obviously a growth company, but this is an insane amount of price to free cash flow. And with Amazon, it can be a little bit skewed because they do spend a lot of money for capital expenditures, because they do make a lot of new warehouses and all that. So this can be a little bit of a skewed value for Amazon. So maybe you don't want to pay too much attention to Amazon specifically, just because again they really spend money on their infrastructure and capital expenditures. But it kind of gives you a picture of what the overall market in this kind of for big companies is doing right now. And let's move on. All right, the next thing that I want to examine here is the price to tangible book value, P to TBV as it's called, and again that's like the last 12 months. Now, tangible book value, think about it as the book value of the company that you can touch, sort of. So it excludes things like the goodwill, for instance, or intangible assets. So it's basically money, for example, buildings and things of that sort, and compares that to the price of the stock. So we can see how many assets we're getting for the stock price that we pay, for the amount of money that we invest. And so here you will notice that again, Alibaba used to be much more expensive, and right now it's sitting at 3.1, which tells us that for every 3.1 dollars of price of money that we pay, we get $1 of assets of tangible assets from Alibaba. And so obviously we want to pay as low as possible, so the lower the better. And let's examine Tesla right now. Tesla sitting at 27.8, which is much more expensive, and as you can see, and seems to be growing, can keep growing, although it used to be even much higher here. So things are getting a little bit better. Now, I'm gonna be adding Apple here as well. And again, you will see that Apple's price to tangible book value is very high as well, sitting at 37.3 right now. It's actually even higher than Tesla over here. So they do have less assets than Tesla compared to the stock price. And the next one and the last one for this metric is the price to tangible book value of Amazon. And this one is actually lower because Amazon may not be too worried about free cash flow as we saw earlier, but they do accumulate assets, and so that's a good thing. And if you compare all these, you can kind of see why Amazon may look like it's very expensive when you compare it to the free cash flow of other companies, and it kind of is. But again, as I mentioned earlier, that's because they are investing a lot, and so you can actually see that in terms of how much money they are making, they may even be better than Apple and Tesla over here. Tesla for sure, because Tesla is massively overpriced, generally speaking. But if you compare it to Apple, they may actually even be better, just because they seem to be accumulating assets faster, again compared to their price, to the price of the stock. So that's something interesting to take a look at and bear in mind. Okay, and now let's examine a little bit of a negative aspect of Alibaba, and that is the return on invested capital. And this is a metric that kind of tells us how efficient a company is with managing capital and how much money they can make on that capital. And so you will notice here that Alibaba used to make about 9 to 8% for the most part, but now it has fallen to 6%. And this kind of shows potential inefficiency for Alibaba, making capital on the capital that is deployed. And let's examine that and compare it to a company like Tesla, for instance. In this case, actually, Tesla is better. It actually used to be worse because they were losing money for quite some time. But now it's actually getting better, and it looks like they are sitting at 10%. And this is definitely a much better number, especially for a car company. What about Apple here? Apple has an insane 35.17%, and this is why you could find, if you take a look deeply, deeper into metrics, you can find all sorts of reasons why to buy a company, and this would be one. Apple seems to be extremely efficient with allocated capital, and so they're making tons of return on that capital. So this is a great metric, and this alone could really allow me and propel me to pay more for Apple, a higher valuation, because I really like the fact that they are, investing their capital in a great way, and actually this capital is bringing them more capital to deploy in the future. So that's great for a company like Apple. What about Amazon? Amazon is actually sitting similar to Baba, as you can see here. Alibaba, it's almost aligning here. Small difference. Amazon is slightly better, but it's practically the same thing. And so you will see here that these two companies, for instance, are Alibaba and Amazon, may be a little bit inefficient, sort of like inefficient giants. You could think of it this way. And they're in pretty much similar space here. So hopefully this kind of metrics kind of give you an idea. I wanted to create this video and kind of showcase how Alibaba compares to all these very big companies here, and kind of examine all these different metrics here so that you can get a sense of whether it's worthwhile buying Alibaba or any of those other companies as well. So I hope that helped you a little bit. And if you did like this video, please like it, because that really helps the channel grow. It helps me a lot. And you may also want to subscribe, because there's gonna be a lot more. In the meantime, you can also watch this video that I made earlier, and talks about Alibaba's earnings, which were modest, I'd say. So let's take a look at this one, and I hope you will have a great time. So thank you for watching this, and see you soon. Bye bye.